The risks are real. A lot of people think because these apps sometimes look like a bit of a game. It's not really a game, it's people's lives, it's people's money. Yeah, you absolutely can make a lot of money, but realistically, you are probably going to lose.
So how did you get out at the right time? How did you know? What were you looking for?
I don't think most people are naturally wired to be traders. Most people don't invest, and I think you've probably got to be further down the route on investing before you get into trading to be that comfortable with risk and prediction.
Can trading make you super rich? Welcome to Investing Unlocked, sponsored by Pension Bee. Making money makes sense with me, Georgie Frost.
And me, Rick Kelsey.
Well, joining us today is one of my favourite online finance guys, trader Michael Taylor, aka Shifting Shares. But first, Rick, trading.
Yeah.
Have you ever dabbled?
Yeah, I have. 2008, the world's up in arms, and you think, well, how can I make a quick buck? And I was thinking, well, you're reading Money Week, various investments, brochures, magazines, and I kind of got really into the idea of commodities in Eastern Europe, sunflower oil, wheat.
I mean, obviously.
This type of stuff.
Naturally.
And then I also thought, well, we've had a big problem with housing stock, both internationally and in the UK, and the UK government are going to throw a bit of money into that. So I thought, well, two areas I can go into is food and housing. And go down the line, few weeks down the line. One did very well, one did very badly.
Yeah.
Yeah. So I think kind of the trading issue here is, what's your intention? Why do you want to be in the game in the first place?
Because you're interested in Eastern European commodities and sunflower oil.
Potentially, and that was the one that didn't do very well.
Oh, bad luck with that.
Whereas the housing stock did slightly better.
Yeah, funny that. Yeah. In 2008, I was a jobbing sports reporter in Hartlepool, of all places. So I feel we've come full circle, Michael. You're Hartlepool boy. Welcome. Thank you for joining us.
Thanks for having me on.
Firstly, can trading make you super rich?
The short answer is yes. The other short answer is, but probably not. I would add to that. There are some fantastic traders out there who make a lot of money, far more than I do, sadly. But most people will lose. They might even lose more than they own. I've had people message me saying that they've lost their housing deposits, marriages have gone. There's been a few times where people have put everything into a stock. They've posted on a bulletin board, like, I've lost everything, I've lost my mother's pension.
Oh, wow.
And then the police have been called so that the bulletin board can try and identify that person. The risks are real. A lot of people think because these apps sometimes look like a bit of a game, it's not really a game, it's people's lives, it's people's money, people's livelihoods. So yeah, you absolutely can make a lot of money, but realistically, you are probably going to lose, and that's backed by the statistics. So since the 2018 European Securities and Markets Authority came in, they limited leverage limits for retail traders.
Backtrack, what does all that mean?
So leverage is if you borrow money from a broker. So let's say I would put in £10,000 into a broker. If I was a retail trader, I would be able to get, I think, max of 5-to-1 leverage. So that would be £50,000 that I would be able to have access to. But I also wouldn't be able to have negative equity. So if I lost the lot, I wouldn't owe the broker anything. Now, before that, you could just open a brokerage account, do whatever you want, and lose your house with a single button. So it was a really good thing that was brought in. But the other thing which is relevant is that they brought in where each broker has to put the statistics of how many clients lose. And it's always above 60%. I don't think there's a broker at the moment that has less than 60% losers, usually 60, 80, 90. So the statistics are that you will probably lose money trading.
Whether you're trading or investing, and whether you've tipped into...
What is trading? What is investing? So it's they're similar, but it's just the time scale that's different?
Well, it's intent and it's time scale. So if your intent is to make some money off some wheat sales because you've seen there's a war going on, and you think, well, you know what? I think the price of wheat is going to go up there because they can't get ships out of that route. So you can see the short-term change that's going to happen there. Right, you might buy some wheat, and your timescale is short. Whereas
Days,
weeks.
minutes.
Whereas if you look at that at wheat sales and think, well, you know what, I'm into agri-tech, agricultural technology, and you think the world over the next 10 to 20 years has got an increasing global population, and there's going to be more need for wheat and food sales globally. That would be investing because you're into food, so you're investing in wheat as a product, whereas the trading would be a short-term hit because you think that's going to go up quickly, and it's all about predictions in a short-term environment.
Timing the market. But we always hear, don't we, Michael, you can't time the market.
You can, but again, a lot of people probably won't. But to add to that, yeah, I would say investing is you were looking at the full business or an asset and making a longer term judgment of it. Whereas in trading, I'm just looking at a chart and essentially how to grind out profits. So I've brought fraudulent companies before because I don't really care as long as they go up. And it's quite funny, even if you tell people it's a fraud, you just get attacked, you get threatened. I've had legal threats before because I wrote something bad about a company, which was true. Never get any apologies, but yeah, that's life. But yeah, a lot of the time, people don't really understand what they're buying and trading. So that is partly why a lot of them lose. And also, people just aren't naturally wired to be traders.
That sounds to me that I'm not naturally wired to be a trader.
I don't think most people are naturally wired to be traders. You know, most people don't invest, and I think you've probably got to be further down the route on investing before you get into trading to be that comfortable with risk and predictions.
To me, yes, they're in the same ballpark, but you're playing a different sport. To my mind, the psychology feels a lot more different. Like you say, the timescale, the risk, the everything. So I can understand why, perhaps young people particularly got very much on board the sort of crypto trading bandwagon, but yet didn't have a stocks and shares ISA, invested there. So I can totally see why for some people it could appeal who necessarily would be quite bored with the concept of investing for decades. Do you invest as well?
So I'm a limited partner in a VC company, so I don't invest in listed businesses. So it's all done by a manager in early stage US tech.
A limited partner in a VC company?
Well, a VC fund.
What does that entail?
So I will invest into a company which is managed by a fund manager and also invest in special purpose vehicles or SPVs that get early access into a company. But it's usually, it's always non-listed. So it's fully private. So I might get returns if I have any in the next 10 years. I certainly won't be getting any in the next year or two.
So Michael, you don't have a plain good old ISA or a...
No, I do. I do have an ISA, which is where the bulk of my money is. So it's all tax free.
How did you get started? Like, what did you do beforehand? And then you thought, do you know what? I'm going to start trading. Oh, I'm actually quite good at this.
So a bit of luck, really. So I had money after I graduated, and I put it into a FTSE 100
You had money after you graduated.
So I did work through
because
graduation.
Every student now going, what?
Yeah. I was quite frugal. I saved up quite a lot.
Good Northeast man, yes.
Yeah, and the old 3 hammers for £2.38 helped as well. 2 litres with an extra litre free. So that went a long way. But yeah, I had money coming out that I'd saved up, and I put it into a FTSE 100 tracker, which didn't really do that well. And I was thinking, like, maybe arrogantly or naively, I thought, maybe I can do better. So I started reading about investing and about different companies and stuff. And I did have a bit of luck, but it was also a very easy market. So 2015, 2016, you just couldn't help but make money. It was like 2020, 2021, but not as intense. And I was working a recruitment job in Germany, but doing far better with the shares that I was spending 10% of my time on.
Wow.
So in the end, I jacked that in. Went to Deutsche Bank, borrowed 25,000 euros. Not that I would ever recommend to do this.
Yeah.
But to me, it was a very easy trade because I was earning terrible money. So I could just go back and earn terrible money. I could get another recruitment job. And I had a loss limit. Like if I lose a certain amount, I'll just say it's not working for me and give the rest back. I think in reality, I was prepared to do whatever it would take. So I would have gone back to McDonald's or done whatever to keep on going. But because it was an easy market, that 25,000 became more. And I've just carried on since. So yeah, quite a bit of luck. I don't really mind admitting that, but also a bit of risk taking.
Yes,
But
so the confidence of youth, because if you've got a couple of kids and you're a bit older, then you're unlikely to go,
that's it. I didn't have a mortgage. I didn't have any kids. So I think if I'd have carried on and I was making a really nice salary and, you got the mortgage, then you got the kids, there's absolutely no way I would have started trading.
What type of personality do you think it takes to go from someone who invests? There's a certain personality type who's got to be open for that risk. Because if you look at the major trading platforms and how they make money and who's making money, the reason they're allowed to give such good deals on their investment side is because the contracts for difference, which is the CFD arm of the platform, is the bit that makes all their money. The contracts for difference, CFD arms of these major investment platforms.
What does that mean? Just explain what that means.
It's essentially the trading arm where you pick certain companies on a short-term basis and decide whether or not they are going to go up or go down in value.
Pretty much, yeah. So
I'm glad I did it in a sentence.
Yeah.
Yeah.
I mean, basically acts like a stock.
Yeah, acts like a stock.
But you've got finance built in and usually a lot higher commission. And it's taxable.
The reason a lot of these platforms can charge such low fees is because of this contracts for difference arm, which is the trading arm, where they are making literally billions. Now, if you dive into their accounts, like someone who's a bit sad like me, and sees how much they're making, well, it's absolutely millions of pounds. And if you look at how much they're making from the investment arm, so you and I doing ISAs, it's tiny amounts.
I mean, that's absolutely true, yeah. Now, there are two types of those companies. So IG doesn't make any money from client losses. XTB doesn't. I'm pretty sure Trading 212 doesn't, but I also don't know. So maybe that's wrong. But these companies don't actually want losers, because if they have losers, then if you were not hedging those, they could essentially bankrupt the company, or you have to really limit them. So the really dodgy ones, which are often overseas, I've had offers of £2,000 a sign up before. The only reason they can offer to pay me that much is because
that is crazy.
It is crazy.
Yeah, watch out for that.
The only reason they can afford to pay that much is because they know that 90% of traders are going to do their dough within 6 months. Let's say you open an account with a dodgy overseas broker, right?
Hopefully not, but...
No, well, let's say if you put in £5,000 and you also like Ukrainian wheat or something, so you go long...
Big fan.
Ukrainian wheat, and that trade loses money, so you lose £2,000 on that trade. Now, if the broker has hedged your position in the market, they will not make any money from you apart from the commissions that you pay because they've hedged it. If they don't hedge it because they know most people are going to lose money, you lose 2,000, they gain 2,000. So that is why a really good broker will hedge all trades, because they don't want any risk of blowing up. So that really is the danger, and companies have gone bust because clients have taken on too big a position and just blown them up.
I want to sort of take it back a step and get a bit more into sort of what you do and what's involved before I make a decision as to whether I am too lazy for trading, which I suspect that I am. What's your trading philosophy? And two, what does it involve day to day? I mean, are you literally the sort of person that walks around with your mobile phone, quick, I must sell, So
in COVID, I was doing 16-hour days because it was pretty insane.
And how long do you hold a trade for?
Depends. Most of my profits come from anything from 3 to 9 months, but sometimes they're seconds.
Whoa.
So, yeah, it really depends what type of trade it is.
What's been your best? What's been your worst?
The best one, I think, at the time was a company called BidStack, which I knew was dodgy in the end, but I also knew it was a high chance it was going to go up. So that's all that really mattered. Best percentage
And did it go up or down?
It did go up, yeah. And then it eventually went bust.
So how did you get out at the right time? How did you know? What were you looking for? Even if you say when a company's dodgy, and I don't know how dodgy can be a big spectrum.
Yeah, I mean, at the time, I didn't know it was fully dodgy, but I knew, like, the trade was that this was a really exciting piece of technology, and there's a risk of me losing 50% of my money in a year, or I make 100, 200, 300%. So it was asymmetric risk to reward, and I knew it had enough money for, at least a year. In fact, one of the criteria I gave to the company, I said to the broker, I will only give you money if they raise 10 million at least. So I know they've got well over a year in fees to go through.
Was this a UK company?
It was a UK company.
Because that's where you specialise, Michael, isn't it?
I only do UK stocks, yeah. I don't do crypto, don't do Forex. I'm just not clever enough for it.
That's pretty important, I think. Having a specialism like Michael has, and having a specific area where you know a lot about what's going on, that's vital, isn't it?
Yeah. So I did a reel on this the other week about oil. There are going to be a lot of people opening apps and starting trading oil because they've seen it in the headlines, and they've just got no chance. They're liquidity food. They will lose their money.
Well, it's too late.
Why is that?
Because by the time you're seeing it in the headline, it's usually priced in. So there are people who have entire teams, computers the size of this room, backed by money up to their eyeballs, studying the oil market. And the chance of you sitting behind a computer looking at a headline and making money is just, it's not going to happen.
This is, to me, trading full stop. Is like, what makes you think when you, not just the intelligent people who are all sat round and you're monitoring markets, but also the technology they use is so fast. Flash boys, Michael Lewis, you can get these trades really fast. What makes you think you are faster and smarter than these people? And that's not a question to you. That's a bit aggressive.
It's a niche, isn't it? I would say when it comes to trading, it's Michael's basically the image of how to make it work, because he has found a niche and he picks specialist companies in the UK market, which not many people have heard about, and he knows about their results and reads papers and looks about what they might do, whereas most people, when they think, you know what, I'll get into trading, they probably go something called Forex. They probably look at foreign exchange trading, of which the two biggest types are basically betting about whether or not the dollar is going to go up against the pound, or whether the dollar is going to go up or down against the euro. And if you think you're probably going to win on that market, then you might make a few quid or a few dollars, but literally that is the biggest form of trading in the world. Betting on foreign exchange.
So you're against that crowd? What's the point? But then it goes back to the question I asked you. What's involved? I don't think Rick spends every day with you, but he's probably explained very well what you do most days. But the 16-hour days, what are you doing? What are you reading?
Well,
what are you looking for?
COVID, so
I know. Now it's just 15.5 hours a day. Yeah.
It's a lot less, but so you were exactly right. My specialism is UK small caps, because I'm not clever enough to do all the big trading. So I stay in my little niche, because there's a few fund managers out there who are active in sub 100 million, sub 250 UK stocks. But most of the people are just people like me, the average person, and most of them are not really sophisticated. They don't really understand what they're doing. And as a result of that, you get stocks that are either mispriced or where the upside has significantly changed, but it's not been factored into the price. So that sometimes is the trade. That there's new news that changes the business's trajectory. There's a swing in the price going upwards, an uptrend, and just the market has yet to catch on. So those are my best trades, and they last 3 to 9 months.
What are you looking at? Say you see Georgie and Rick Limited,
right,
or something, and you think, this looks interesting. What is it that you're looking for? Interesting, good or bad, either way.
I mean, it depends on every company. So, for example, there was a company called McBride, that the market thought was going to go bust. And it actually looked like it was going to go bust. It looked like it was going to breach its debt covenants and then game over. And then it put out an RNS, so a piece of news on the London Stock Exchange.
Regulatory news service.
Exactly. That it was trading ahead of expectations and that debt had actually come down a lot faster than expected. And the price didn't really jump that much. So given that suddenly things were getting better, and when things start to get better, they usually carry on. Obviously, it's not guaranteed. But these things happen, if a company puts out a profit warning, there's never just one cockroach. It's usually the start of something because management are always optimistic. But when things are going from bad to not as bad, that can sometimes be the trade because you won't have people jump on straight away. They will wait for confirmation. But at that time, the risk to reward is usually quite good because the stock is priced to go bust, yet it's told the market there's a chance that it now might not go bust, which might not be priced in. So my job really is to look at the odds, assess them properly, and make a judgment using risk management, position sizing, entry and exit. So you could say it's sort of like gambling, but educated gambling.
It comes a lot down, I think, to your personality type and how much you're happy to dive in on timing. With investing, we're constantly told that when there's a dip in the market, don't do anything. If we look at 2026, for example, I'd suggest that the first half of 2026 would be a really good time to lose your investing platform password and just don't look at your ISA. Really just, some of the most successful investors I know don't look because they just put it in every week, every month. And it just goes in and they don't make big decisions based on sways when there's a war and the oil price is pushing up the price of every single commodity you can think of. But with investing, with trading, it's the opposite because you are constantly looking for timing, like Michael says, of the market, and you've got to be comfortable to be jumping in and actually making changes based on timing. Now, when I shout jumping in, making decisions based on timing, that's the exact opposite of what you and I have probably done for years when it comes to telling people to put a couple £100 in an ISA every month.
Absolutely right. So this time of volatility, I suppose, for you and your trading friends must be, it sounds awful because it's a horrible time that we've been going through, not just 2026, but 2025 and tariffs. And then we can go all the way back to COVID and to Brexit and to, Ukraine and Russia. But actually, is this the time where you do most of your trading?
So I'm not really a big short-term trader. I do it, but again, it's not where most of my money comes from. So once all of this sort of passes, or I might look at short-term opportunities, but really I'm looking for companies that have been overly whacked or to short companies that have not yet been whacked. So my theory is that higher energy prices, a lot of companies have not priced it in. So sometimes I will look for opportunities like that. But again, I make most of my money over several months. So I'll be looking for companies that are overly smacked, where the risk to reward is not it's priced different to what I actually think it is. And to do that, it's research, it's reading back through what the company's done, what the management have said, looking at the balance sheet, income statement, cash flow, looking at recordings of management, see what they've said before, just learning about the business, how all the moving parts work, looking at the capital structure. There's all sorts. So it is hard work. So if you, I guess you also have to do this if you're investing in individual companies. Like most people don't even look at the annual report. They'll buy a stock.
Yeah.
They won't even read the annual report, which is where management puts all the bad stuff because they know most people won't read it.
Yeah.
So, I think most people should just buy an ETF unless you were prepared to do the work. And you have to enjoy it. Otherwise, you just won't do it.
Before we carry on, a quick word from our sponsor, PensionBee. If you're listening to this podcast, chances are you care a fair bit about investing and making the most of your money. But here's the thing, you don't have to be a pensioner to care about your pension. In fact, the earlier you pay attention, the more powerful it can be. Your pension is likely to be one of, if not the biggest investments you have, yet it's often the one people ignore the longest. That's where PensionBee comes in. They're a leading online pension provider focused on helping people build confidence and take real control of their retirement savings at any stage of life. Their app and website make it easy to combine old pension pots, manage contributions flexibly, and see exactly what's happening with your money all in one place. You can also access your pension from age 55, rising to 57 from 2028. If you want to take a more active role in your pension investing, download the Pension Bee app or visit their website to get started. Remember, when investing, your capital is at risk. What do you think some of the most common mistakes that people make when they first start trading are? Like, what you're now refined, you've honed your skill, but you must have made a lot of these along the way, surely.
Made all of them.
Yeah, there we go.
I think the hardest one is you have to detach yourself from your ego. Like, I can lose money now and I just don't feel it. Whereas at the start, you put a trade on and it goes against you and it comes to your stop and you think, I'll just move it down. Or like you start rationalizing about why it's a good company. And so the short-term trade becomes a long-term investment. But people really don't want to crystallize loss. So it's called loss aversion and prospect theory.
Yeah.
Amos Tversky and Daniel Kahneman did a lot of work on this, behavioral economics. And to come back to what we were saying earlier, all humans are not hardwired to make money in the market because you have to do things that most people aren't doing. So I guess, thousands of years ago, if you thought there was a cheater coming after you and everyone was running, you should also run. But when it comes to the market, like when everyone's selling ETFs in panic now, it's probably not the time to be selling if you are a long-term investor.
I think what you said about the loss aversion is really key. And you said about detaching yourself from ego, because we're hardwired to feel losses more than we are to feel gains. And it's quite difficult to not internalize that and be like, it's because I've made a bad decision. So then you say, well, it must be markets, or you'll push it away. And then it makes it even harder to then sell it. How do you detach yourself? You said ego.
Yeah.
That is difficult to do. How have you learned to do it? Or was it just practice?
Well, it was a case of I either do this or I go back to work. And when I put it in that situation, it was a very easy choice. You have to cut losses if you're a trader. I once had someone email me and said he hadn't made any money in 10 years. And the reason he hadn't made any money, he made some good trades, but he was holding on to stocks, that had gone down 80, 90%. He just never sold them. And if you removed those losers, he actually would have done all right. He would have been profitable, but he just couldn't get over the fact that he had to cut his losses.
When's the point you go, that's out?
So the best time to do that is before you open the trade. Because once you open it, you've got confirmation bias, your ego wants to be right, and you are just inherently biased. And even if you're aware of that, you can't actually get rid of the bias. So you have to make a plan beforehand and then stick to the plan. Otherwise, you risk making subjective and suboptimal decisions. So even with investing, like ETF and stock investing are two completely different things. Because with an ETF, you don't have any idiosyncratic risk, which is fancy finance term for individual risk.
Yep.
If you buy 10 stocks, you have a very concentrated portfolio.
Yeah.
Now, that's not necessarily a bad thing, but it could be if you've got 10 stocks in the oil industry, obviously that account is going to be tied towards the oil price. But if you buy like the FTSE All World, you've got 4,000 different companies. Yes, there's a heavy weighting to US tech still. But if one company goes bust, it's not really going to affect you. Like, you won't even notice. Whereas if you've got an account of 10 stocks, you will notice.
You had a great reel about that when you said you've got some of the best companies in the world working for you. I enjoyed that one.
They all work for me, yeah, exactly.
Talking about social media, and we've done a special on this, so we don't need to go in too much depth, but that's where I first saw you. And I have encountered a number of traders online as well as in real life. Some are obviously, like yourself, very sensible, very good. Some not so much. Does it make you despair the amount of crap, basically, that you see online that people spout?
Well, you got this dude, HS Tiki-Toki.
Well, yes, indeed.
And he must be making like so much money. It's unbelievable. He's got like 500,000, I think it was, in his Telegram group. And he will have a very, very good deal with a broker, because that broker knows that he will funnel loads of people.
How does it work?
In.
What he's doing? Is he driving people towards an app, a trading app?
Yeah, so he will drive people towards an app
Yeah.
where he gets commission. I would imagine a few thousand on every person that signs up. I mean, if I've been offered that, he'll be offered more, along with bonuses.
Have you never been tempted to take it? Because you must get loads of people
I don't
offering
need the
stuff.
money, so no. But I can see why people do it. You know, if you're 20 and you have a really terrible life, suddenly you can start to rationalize it and think, oh, well, it's not that bad.
So how do you then filter out what is the rubbish, basically, the wheat from the chaff? Because as I said from the start, there is so much information about it online. Trading is seen as like the route to riches, and it's so simple to do. I was on a panel with a trader who said, yeah, anyone can do it. Well, probably technically lots of people can do it, but whether we should do it is a completely another issue. But then how do you pick the people where you think, actually, this is sensible? Because what I like you is I'm not going to trade. I'll be honest with you. I'm not going to be a trader. But I like the information you give me about the companies. I like the information you give me about what's going on in the world, because I think all of it filters down and is relevant to, even if you have your money in an all-world tracker, for example, like you said, very heavily weighted to the US, very, very heavily weighted to tech. You might want to think about adding another ETF that might balance it, or something like that basically balances your portfolio, even though you have 4,000 of the best people in the world working for you, as it were. So how do you filter out what is rubbish?
If someone's saying something that is too good to be true, then it probably is.
Common sense.
Yeah, I mean, I think
short supply sometimes, though, when you need money, when you see
these people are
so
obviously
convincing.
making money.
They're so convincing.
But you know, if someone's in front of a rented Lamborghini and you are not getting red flags, and they're saying you can make, 15 grand in 10 minutes and I'll teach you for free. I mean, I don't want to be mean, but you are a bit dumb. Let's be honest. Or you were really desperate. And I think that's sad, because sometimes maybe people are really desperate and they suddenly start clutching at these things that they see online. Some people are just lazy and think, right, I don't want to actually learn to trade. I'll just copy this guy who says he'll make me rich.
Yeah.
But then there's the people who are desperate and they're chucking the last few £100 in and losing it all.
Yeah.
So they really wind me up. I hate them.
Yeah. But also the other element to it, and I jested when I said you were quite nerdy, but what I was doing, I was comparing you to, certainly, there's been a few that I've met in real life, and you just look and you think, like, there's an element of, and I can't think what else in finance is similar to this. Maybe crypto, but I still think crypto's got a bit of the touch of the nerdy kind of, geeky element to it, of masculinity. The strong male perfume of the guys that I met, that I trade, therefore I am a man.
So what I do is quite boring. Like, if you would look at me on the screen, I could lose any amount or win any amount and you just wouldn't see a change. Like, I've trained myself not to feel emotion.
I can believe that about you. You seem a steady chap.
Well, I've also learned that, when you make a lot of money, you get overconfident and then you lose a lot of money.
Yeah.
So I'm always quite guarded. If I ever do quite well, I'll step away and, let everything calm down.
To be honest, Michael's videos about fake traders and fake property moguls running into hotel lobbies and out the back are anything but boring.
So that's like the creative outlet, because trading can be creative in a way that you were trying to express different opinions through various assets, but I think it would be a stretch to call it creative. But it is quite boring, and I guess in the city those people exist, but usually when I go to investor lunches and trader lunches, it's like older men who've got stocks and shares ISAs. They're doing the same thing as me. So not like the rock and roll lifestyle you might associate with a trader. In bed by 9.
It's because you've got to be so involved with the research. If you're doing it, what Michael's doing, you've got to be looking at the research journals. You've got to be going into absolute depth on stuff like, inflation, looking at CPI, the Consumer Price Index, and looking at different countries. Where's their inflation going to go? That's all relevant to trading. If you're not interested in doing that kind of work, then trading is probably not the thing for your personality type.
Absolutely. Well, if you want to do it, or at least have a chance of doing it well, then it's probably not the right thing to do.
Yeah. Unless you're going to take a lot of time and you actually enjoy it, just buy an ETF. Yeah.
I was going to say, but it's one of the things that I certainly hear a lot of people who say that they don't invest because almost they think they need to do that level of knowledge and research to even begin to start investing. Investing, it's not for me, don't have enough money, and I'm not a financial whiz, so therefore I'm not going to bother. But actually, yes, for trading, you do need to do that.
Yeah.
Without a doubt. Investing, you can get around it.
If you're investing in ETFs, you have to do a lot less research than if you're investing in individual stocks. Yeah, exactly. So the average person can open up a stocks and shares ISA, buy a global ETF, and that's probably sensible. And financial advisors really don't like me, but I'm not actually against them. When you've got a lot of money and you want to set various objectives and look at your estate planning, it probably makes sense to get a financial advisor. But when you were just starting off, I mean, St. James's Place, until recently, had like a 5% product charge, 1.6% ongoing fee. If you invest 10 grand, do you want to be given 690 quid to them in year one? That's quite a big hurdle. So, yeah, I would say no. But certainly in later life, maybe yes. Not to them, but someone else.
The fees are a really important point. We have touched on it before, but just, when we think about the sort of platform that you want to use, fees are vital.
Yeah.
What are you looking at with trading as opposed to that you would be with investing?
So for me, execution matters most. I don't actually look at the fees. Obviously, I don't want to pay fees if I don't have to.
Yep.
But I would rather pay higher fees if it meant getting a really good service than... I mean, HL was down.
And what's a great service look like on a platform?
So I want to call my broker. It answers within a few rings. I want to give them an order within a few seconds and they go do it. And the trade can be done within 30 seconds from me saying, hey, Siri, call IG or Maybank or whoever.
You're famous for promoting small businesses. That makes sense.
Yeah.
You're investing in a lot of them. But is there ever a time when you'd go, no, morally, this company I just don't want even my money to go anywhere near related to this?
No.
No, right,
no.
Great.
So I prefer to just focus on pure performance in the market. And then I do my charitable decisions myself. And the problem is you could, if you started not buying stuff based on moral things, you would just end up owning nothing. I mean, defense companies, do you look at gambling companies? Now, I don't agree with gambling.
Yeah.
But people should be allowed to gamble. It shouldn't be pushed off.
Pretty much impossible to hold an ETF.
I'm reading a book called Code Dependent, which is by the AI editor of the FT, talking about, the factories that basically these people in poorer countries are working in to try and, figure out the AI that we then use. I mean, some of the images that these people have to see are absolutely horrendous. There's awful, you think about the climate impact of things like AI. It's not without its negative sides too. So I agree with you on that one.
The only time I might consider it is if I was funding a company directly that I really didn't agree with, but I don't think that's ever happened. But even then, I would probably still take the trade because to me, it's just a trade. I can't really allow emotions to get in the way of it because then I make subjective decisions. So same reason I will quite happily short companies, and a lot of people will say shorting companies is bad, but there's never been a really good high quality company gone bust because of shorters ever. It's just never happened.
No.
And if anything, it's an opportunity for investors to buy cheap stock if a company gets whacked by shorters. So it's, it helps with price discovery. It's absolutely necessary. So I never feel bad making money off a company going down, even if I know that company's going to go bust, and I might sort of help it along the way by hurting the price sometimes. It's just the market. People
creative
have the
destruction and all that sort of thing.
Yeah, we need to allow companies to go bust and capital to be allocated towards better ventures.
Yeah. What questions do you think we need to be asking ourselves before we get started with trading?
Do I even want to do this? Because I think people just don't really have an idea of what's required. I think even I knew the success rates when I started, but I just wanted to do it, and I was prepared to do whatever it took to learn. And I thought maybe arrogantly, because probably no one starts trading thinking I can't do it.
Yeah.
But I knew what I would have to do, and I don't mind doing the work because I enjoy it. So for me, like, I thought, man, if I could do this every day and not have to go and call people or work in a desk, because I worked in Vodafone before, and that was like properly tedious work. And I thought, oh man, if I could just read about stocks all day, that's like the dream.
Yeah.
So I was fully prepared to, and again, I didn't have a mortgage or kids, so I could do that. Bit different if you're 40, you got the kids in private school, you got the mortgage, 3 holidays a year. You know, is your family going to be supportive of that decision? Like, you know, if you're looking at trading, you've got to get the wife or the husband on board, because it's not just affecting you. You might have to ask them for a lifestyle downgrade so you can follow your dream, and that's going to be a tough conversation. What happens in a year? Because if you're pressured to make money, that just makes everything so much worse. Like, if anything, if I can get my business to cover my costs, I will be an even better trader.
Yeah.
Because I can size up in my more risk asymmetric trades and keep a cash buffer, whereas I spread it quite thin because I'm reliant on it constantly. So you've got to get the family on board and ask yourself if you actually want to do it.
And so you do want to do it, right? You are not going to be amazing at the start.
Yeah.
Likely, unless you already work in a profession where you are doing all this research. So what things would you recommend? What, I guess, newspaper articles, what online accounts, what would you recommend to do the amount of research that you need to really get going? Like, what are your most valued resources?
So I can only really speak for UK stocks because I don't trade
for sure.
any other markets, so I wouldn't be able to comment on that. But in UK small caps, there's 1,000 stocks. If you know more about most people than those stocks, you've already got a bit of an advantage for when another piece of news comes out. And if you understand how the market works, which, you know, it's not just as simple as opening an app and pressing buy. There's a huge amount of infrastructure that goes on there. So market makers, brokers, secondary placings, IPOs, auctions, DMA. Once
But
you
what are
actually
you reading to get that knowledge?
You just have to go down the rabbit hole and learn. You know, that's what I did. So yeah, RNSs help, a good data platform, a good broker, and also speaking to people. I've learned a lot from just asking people questions, and usually people are quite happy to impart some wisdom because they feel a bit valued
because they've got nobody else to talk to it about.
Sometimes, yeah.
Yeah.
How many trades do you have going on at one time?
So I think at the moment I've got about 10 positions.
Okay.
But sometimes I'll make a few trades a day. Sometimes I'll do none. So yeah, sometimes it can be quite active. Sometimes it's just looking at the news, catching up on what's been going on, and thinking about what are the next big potential themes and how to price that in and work it out.
Michael, finally, the £1,000 move. If I was to unexpectedly give you £1,000, what would you do with it?
Probably something quite boring. Yeah, I mean, I'd probably just put it in my... I've never actually maxed out my ISA allowance. Well, I'd never earned any money from a job, so never really had the opportunity to.
Wow.
So I'd probably put it into a stocks and shares ISA.
Yeah.
There we go.
Very boring, but yeah.
No, that's a great response. Rick reflects.
When it comes to trading and whether or not you should get into trading or whether you should take a next step into trading, I think you've got to think about kind of 3 things, which is your intent, your timescale, and your personality. Your intent being what you want to do with the money, as in, do you want to make a quick buck? In that case, maybe trading is more for you than investing. Your timescale, how long do you want to be in this for? Do you want to be in this for a couple of weeks, a couple of months, and you're happy with that? Or do you want to play the long game, which is more secure with your money? And then your personality, a bit like Michael's been talking about, have you got the personality who can deal with losses and not be bothered when they happen on regular and short-term cases? Because that is what is going to happen when you bet against stocks going up or down in a short period of time. And you've got to have the personality who can deal with that and be happy with it, which probably means that you're more financially comfortable in the first place and have a background that you can take the shock if it happens. So they're the type of people who trading might work for.
Or you're young enough, as Michael was, not to have the weight of the responsibilities. Rick, lovely. Michael, thank you so much for joining us. And thank you for coming along too. If you want to get in touch with us, you can find us on social or you can email us. Remember to hit subscribe so you don't miss an episode, and make sure to tell your friends who don't know their BTOs from their EPSs about us as well. Before you go, just a quick reminder that everything you've heard on this podcast is for information and education only. It's not personal financial advice. Investing or trading involves risk, and if you're unsure, it's best to speak to a regulated financial advisor. If you enjoy Investing Unlocked, especially our retirement episode, then I think you'll enjoy this from our sponsor Pension B, the Pension Confident podcast, hosted by Philippa Lamb alongside a panel of financial experts. It's aimed at those who want to understand pensions and personal finance in a bit more depth, but without the jargon. They cover topics like ISAs, mortgages, the bank of mum and dad, as well as how to become a pension millionaire and the cost of divorce. There are new episodes every month, plus bonus content in between. You can listen on all major podcast platforms, in the Pension Bee app, or watch on YouTube. Just remember, anything discussed isn't financial advice, and when investing, your capital is at risk. Search the Pension Confident podcast wherever you listen.